This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Closing the books, stocks end August with their worst month in more than 3 years. So what does it mean for September? Another gusher, oil spikes again, posting its biggest 3-day gain in 15 years. And Lone Star startups, why one Texas city has become a launching pad for small business. All that and more for Monday, August 31st. Good evening, everybody, and welcome. I'm Sue Herrera. Tyler is off tonight. Oil prices spike again, pulling together their biggest day since 1990. More on that in just a moment. But first, despite that turnaround in oil, stocks wrapped up a very bad month of August. You know the story: fears over China's growth and uncertainty about the timing of an interest rate hike by the Federal Reserve. And that led to one of the worst months in years on Wall Street. Today, the Dow Jones Industrial Average fell about 115 points to close at 16,528. The Nasdaq shed 51, and the S&P 500 lost 16 points. But for the month, the Dow was down about 6.5%, its worst month in more than 5 years. The Nasdaq fell nearly 7%, and the S&P 500 shed more than 6%. For the Nasdaq and the S&P, it was their biggest monthly percentage drop since May of 2012. So August ends with steep losses and heavy volatility, and we head into what historically is one of the worst months for stocks. So Dominic Chu looks at whether or not history might repeat itself.
For many, August has turned out to be a month they'll soon try and forget. Investors and traders witnessed some of the worst monthly losses in years, and measures of stock market volatility soared to new heights. All of this amidst a big backdrop of uncertainty that may continue into September and beyond.
I'm hopeful that, perhaps we've seen some of the worst of the volatility, because I feel like we cleansed our palate, so to speak, in terms of getting that, 10% correction that we were long overdue for. That being said, a lot of the things that I talk about as to why you should expect volatility are still out there. So Fed still hasn't moved yet. China certainly is probably going to continue to be struggling for some time, perhaps a lot of the other emerging markets as well.
Market history may be on the side of the bears as well. According to S&P Capital IQ strategist Sam Stovall, since the end of 1945, September has been one of the worst months for stock market returns compared with any other month. The S&P 500 has fallen by an average of 0.6% during the month since that time period. That factors into the more pessimistic case for stocks. But it doesn't mean everyone is running scared.
We see fundamental earnings growth here in the U.S. positive. We'll get hopefully some good news out of the third quarter releases as we get those in early October, and that could provide a nice tailwind for markets. Couple that with the fact that the recent correction has pushed valuations down to a much more reasonable level. We think it sets the stage for what could be a pretty good market coming into the end of the year.
The bottom line here is that investors should brace for what could be more ups and downs in the stock market, especially with a lot of variables, both known and unknown, in the coming months. For Nightly Business Report, I'm Dominic Chu.
One of the things going on in this crazy August market, the stunning comeback of oil prices. Today, prices continued that rapid climb. Domestic crude ending up nearly 9% at $49.20 a barrel, and put oil up 27% since Thursday, its biggest 3-day percentage gain in 15 years. Jackie DeAngelis looks at what's behind the huge moves.
Crude oil prices reversing today to end the session up $4. WTI finishing at $49.20, a nearly 26% gain in just 3 days. Traders weren't necessarily expecting this today. As a matter of fact, the session opened lower as the markets were pausing to digest some of the news that we've heard as of late. But then some headlines that major producers and OPEC players were willing to sit down at the table to talk about stabilizing the global marketplace sent prices higher. In addition, the EIA came out with production data for the month, showing that in June, the U.S. produced 9.3 million barrels a day. That's down for 2 months in a row from the peak of 9.6 million barrels in April. Then a fire at a Canadian oil sands project because of an issue there, creating a production halt, which could eventually lead to U.S. inventories coming down. So the perfect storm of elements to take prices higher from here. But buyer beware, a lot of this was short covering, and traders still believe those lows we tested at 37 175 aren't out of the question because right now people are moving the price higher on talk of talking. The actual negotiations haven't happened just yet. Reporting from the NYMEX, I'm Jackie DeAngelis for Nightly Business Report.
Steve Wood joins us now to talk more about what lies ahead for the markets next month. He is Chief Market Strategist at Russell Investments. Well, I guess I should take a deep breath that August is over, but I'm looking into September, which traditionally has an awful lot of volatility in it as well. But you say this is a return to more normal volatility.
Yeah, investors have been spoiled. It's been a 6+ year raging bull market in U.S. equities, certainly. It's beginning to get some traction in Europe as well. China had a year, until very recent, was up well over 100%, and in a low volatility environment. So the volatility that we're seeing now is more historically normal. It's just kind of condensed in a couple of weeks as opposed to spread out.
Does it worry you, though, that we saw that 1,000-point gap down? I mean, it seems as though, yes, we're used to volatility, but the extremes seem to be more extreme than what we've seen in the past.
Yeah, I would agree. It's very, very punctuated. So that pattern is somewhat new. But that's why investors need to extend out their time horizon. They need to be globally diversified, multi-asset strategies. It's not just stocks. It's not just bonds. It's a combination. They need to look globally. But I think volatility and return to volatility is something we should expect. There's no reason why tomorrow should be different than today. I don't think the market really looks at calendar dates.
The market doesn't know it's going to be September tomorrow, right?
The orbit of the Earth around the sun doesn't really affect, global asset prices. So I think we're seeing the volatility. There's a Chinese question mark. There's a Federal Reserve question mark. You were talking about oil earlier, question mark. So there's a lot of moving pieces and valuations globally for all these asset classes. Where do they make sense? I think the market's really struggling with that right now.
Let's start, first of all, with oil. The kind of spikes that we haven't seen in multiple years, certainly. And that has brought back the inflation scenario, which leads us to the Fed. So tie that all up in one neat little bow for me in terms of how you view it.
One neat little bow would be the Fed. I mean, if I had to boil everything down to its most critical element, I'm going to look at the Federal Reserve. Whatever Janet Yellen does as the chair of the Federal Reserve, that's what we want to know. That's the most important thing. Right now, inflation is very, very low, and the Fed would like inflation to be higher. So when they talk about price stability or inflation stability, it can be too low as well as being too high. It's just that most people our age have had experience with it being too high in the 70s and the 80s. But right now, inflation is a little bit low. So I don't think inflation right now is going to force the Fed to do anything they don't want to do before they want to do it. So the Fed has time. Inflation is low. Oil's high 40s right now. It's not at 148 like it was a couple years ago. So I think right now the inflation story right now is still a little bit on the low side. I think the Federal Reserve, just as an institution, wants to raise rates by the end of this year. We still think it's going to be September.
You do.
Higher than
that was going to be the next question.
That's our expectation, that it'll still be September. By the end of the year, the Fed as an institution, they want to have interest rate policy back. They have not been able to have a positive.
Yeah, it's been out of their control
since 2008.
Yeah.
So they haven't had their number one policy tool for pushing a decade right now. So they want to get that back, have a positive rate, and then after that, we'll wait and see. Then I think they look at the data. Then they'll look at inflation. Once they go positive, they become data dependent. All
right, you said to look outside of just the traditional stock and bond allocations, maybe look overseas. Where overseas?
Our overweight at Russell has been, in equity space, has been Europe. We arrived at that conclusion last year. We looked at valuations in the United States being kind of rich. Stocks were kind of expensive. In Europe, they were more attractive. The economy in Europe was coming off a bottom. The United States is kind of a maturing economy. But the United States, as we mentioned earlier, is getting closer to raising rates with each month. Whereas the European Central Bank is going to start printing a lot of money. They're doing a quantitative easing, equity prices like that. And so we still have an overweight to Europe.
All right, Steve, thank you so much. Good to see you again.
Thanks.
Steve Woods with Russell Investments. As we mentioned, the Fed, well, the markets dive right into September with a crunch of economic data leading into Friday's big jobs report. And that data could be a big week for the Fed and for stocks. So Bob Pisani takes a look at what the markets will be paying attention to.
It's a tough week to focus on economics since the market is still dealing with last week's crazy volatility. But economics are really important because, as the Fed's Stanley Fischer said this weekend, what happens with the data in the next few weeks will determine if the Fed will raise rates in September. Fortunately, this week is chock full of data, starting with the ISM Manufacturing Index, that's tomorrow, the first read on the economy in August. We'll also get revised productivity numbers on Wednesday and the ISM Non-Manufacturing Index on Thursday. That's a look at sentiment in the services industry. The most important data point, of course, will be the August jobs report. That's going to be on Friday. Traders are expecting a gain of 220,000 jobs. That would be the fourth straight monthly gains over 200,000. One key component will be wage growth, which has been roughly stagnant, just about 2% a year. The big issue is if any of this data will be sufficient to turn the Fed's doves into hawks, to turn those who aren't sure they want to raise rates in September into those who do want to raise rates. Now, there are key players like the New York Fed's William Dudley, Vice Chair Stan Fisher, and Chair Janet Yellen, who appear to be sitting on the fence right now. So this is going to go right down to the wire on September 17th. So would the market go up or down if the Fed raised rates? The Fed would not raise rates without a compelling argument that the U.S. economy is improving. Good news on the U.S. economy would mean the U.S. is outperforming the rest of the world and would likely drive more investment into our markets, including the stock market. This, at least, is the hope of the bulls. One thing the Fed is certainly hoping for is that China remains calm. While the Fed does not directly consider China as part of its mandate, raising rates during a period of global turmoil is something they would clearly like to avoid. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Amid all that volatility in energy, Warren Buffett has actually upped his exposure to that sector. The billionaire investor's Berkshire Hathaway revealed it has taken a nearly 11% stake in the oil refiner Phillips 66. The $4.5 billion position rebuilds Buffett's stake in the company, and it comes after it sold off nearly two-thirds of its shares back in 2014. Phillips shares rose more than 2% in today's trading. So here to discuss Buffett's big bet and what he sees in the refiner, we welcome back Susie Gareb. She is a senior special correspondent at Fortune and an NBR contributor. She's covered Warren Buffett for years now. I mean, you are the best Buffett watcher I know,
Well,
Susie.
I don't know about that, but leave it to Warren Buffett to always surprise us. Everybody
Yes.
is all worried about the oil markets, and he's bullish on oil.
So why did he do this particular deal?
Well, I think it's kind of interesting that, you know, he had a relationship with this company before. It's almost like going back to your old girlfriend. It was bad timing back then. Oil prices were very high, and now this might be good timing. The people I talked to, oil experts actually, this time, say don't look at the refining part of this. Isn't really an oil play, but underneath of it are some valuable assets that Warren Buffett is, isolating. Petrochemicals, natural gas delivery, all of these very lucrative, very steady Eddie kind of businesses, just the kind of investments Warren Buffett likes.
Because I was going to say, on the surface, it doesn't really fit into the types of companies that he puts in his portfolio. So maybe we have to look a little bit deeper, as you suggest.
And don't you think like food like Heinz,
Yes.
Sea Candy, Dairy
All the
Queen,
stuff
or
that
railroads?
that ends up on your kitchen table or gets it to your kitchen table.
But there are some similarities, Sue, because these are undervalued assets. He likes unloved assets. It's also, a contrarian play. He always goes against the crowd. People don't like energy. He likes energy. And he knows his limitations. He knows he doesn't know anything about oil. So management is important. And from what I hear, the management people, running Phillips are pretty terrific. They're doing all the right moves, very excellent marks.
He's been making a lot of moves, too. He's been being very acquisitive lately.
Yeah, can you keep up? A few weeks ago, he bought Precision Castparts, $32 billion on that deal. Earlier this year, the Kraft Foods deal, that was like $10 billion. And now this, if you add it all up, something like $50 billion that he's invested. It is amazing. And
especially amid the volatility.
Amid the volatility. And what's also interesting is that yesterday was Warren Buffett's birthday. He celebrated that he's 85. So 85th birthday, maybe this is his birthday present, but I think it's also a message to all of the Buffett watchers that don't count me out. I'm staying as chairman, CEO, and I'm not slowing down.
And I'm doing just fine. Thank you very much, right? Well, we wish him very happy returns. Susie, it's so good to see you again.
Great to see you too,
Come
Sue.
back real soon.
Thank you.
Susie Gareb. More tension with China as talk bubbles up about sanctions over cyber hacks on U.S. companies just weeks before the Chinese president visits Washington. We'll talk about that next. Last week, we told you about a landmark ruling by the National Labor Relations Board that could shake up the relationship between companies and their subcontractors. Home builders say that decision could have a major impact on how they do business, and not in a good way. Diana Uluk has that story.
It's a major change to the government's joint employer status, which could now put home builders on the hook for issues involving subcontractors, such as labor violations and union negotiations. The NLRB declined our request for an interview, but in a release said the board's previous standard has failed to keep pace with changes in the workplace and economic circumstances. Now, while the ruling covers all employers, from fast food companies to healthcare to high tech, it's particularly profound for the nation's home builders. They rely heavily on specialty trade contractors like roofers, electricians, plumbers, framers. They're calling it everything from unnecessary to crippling.
This ruling really, if it's applied to small businesses, applied to the home building sector, really shows no understanding of 80% of the marketplace. It's impossible to comply with and use the same business model that has been working successfully for 200 years.
The builders can't fight the ruling unless there's a specific case brought against them. I did speak with the CEO of Miami-based Lennar, Stuart Miller. He says he thinks his business is highly differentiated from this particular case, but he also says he's alert to the ruling and watching. For Nightly Business Report, I'm Diana Olick in Washington.
The White House is reportedly considering a package of economic sanctions against Chinese companies and individuals behind a series of data breaches against U.S. companies. Eamon Javers is here to tell us what all of this means. Good to see you, Eamon. And how are the Chinese likely to react to this package of sanctions?
That's one of the big questions here, one of the big unknowns, and it might be why the White House is proceeding very, very cautiously with this. You might remember that back earlier this year, the president signed an executive order which sort of laid the legal groundwork for enacting sanctions against foreign actors, that is, companies or individual business people who were involved in cyber attacks here in the United States. Whether or not the United States could actually go forward with this will depend really on how willing the United States is to identify those people in China who've been part of the hacking and really reveal what U.S. intelligence knows about their activities so far.
You mentioned that the White House is going slowly on this, but there must be some challenges for the government here.
Yeah, the big one being that the president of China is scheduled to come to the United States for a state visit in October. So presumably, if they're going to do this, they'd want to do this relatively soon, early in September or well after that trip. Doing that while that state visit is ongoing would be seen as a huge snub to the Chinese. And of course, that question that you asked about how the Chinese are likely to react is the big question here. The United States has been reluctant to push China too hard on all of this, although last year they did indict 5 members of the Chinese military for hacking-related activities. But in general, they've kind of soft-pedaled this, fearing provoking a bigger Chinese reaction. Of course, there could be huge blowback for American companies and corporations if the Chinese decide they need to take their own retaliatory actions, and it becomes a series of tit-for-tat actions and reactions.
You know, moving ahead to when the Chinese president does come to Washington, I would assume also on the agenda, Eamon, will be the market turmoil in China and their move to devalue their currency. The Treasury Secretary weighed in on that, and the president has weighed in on that. That might be a kind of a thorny issue as well.
Yeah, and that's another area where the Chinese don't like to take a whole lot of guidance from the United States. They feel like they know how to operate their economy just fine, thank you very much. Of course, the Treasury Secretary has said that he thinks that devaluing the currency was not enough. What the United States wants to see is a real free-flowing currency that responds to global exchange rates and not something that's controlled by the Chinese government. But the Chinese government is just not likely to let go that lever of power that they control and they wield over their economy.
It's going to be a fascinating visit. Eamon, thank you very much. Appreciate it. Apple and Cisco are teaming up, and that's where we begin tonight's Market Focus. The two Dow components are joining forces to help bring more iPhones and iPads to business users. The collaboration will allow Apple devices to work more efficiently in workplaces that use Cisco technology. Apple was off a fraction to 112.76. Cisco systems fell slightly to 25.88. Google announced its Android watches are now compatible with Apple's operating system. Separately, Google's Life Sciences division is teaming up with the European drug maker Sanofi on new ways to monitor and treat diabetes. Shares were off nearly 2% to 647.82. Bristol-Myers Squibb announcing today that it was guaranteed the exclusive rights to buy a privately held company called ProMeteor and its experimental fibrosis treatments. That purchase will cost more than $1 billion. Shares were off almost 2% to 59.47. FedEx has moved a step closer to a final agreement with pilots. This after the union's executive council voted to approve a tentative labor contract. Pilots will vote on that agreement in just a couple of weeks. Shares were off more than 1% to 150.61. The streaming video wars are heating up between some of the biggest players, Netflix and Hulu, as big movies, including The Hunger Games and Transformers, leave one service and head to another. Julia Borston has a look at the digital content battle.
If you want to watch Hunger Games Catching Fire or Transformers Age of Extinction on Netflix, you only have until the end of September. Netflix announcing it's not renewing its 5-year deal with Epix, the cable channel and digital content service, for the rights to stream its films from Epix's parent companies Paramount, Lionsgate, and MGM. Films that have also been available on Amazon for the past 3 years. Analysts say it's no loss for Netflix.
To write a big check, a couple $100 million a year for movies that are a year old and not exclusive to Netflix doesn't really do a lot for them from an investment perspective. I think they're better off reallocating their capital elsewhere. And you don't have to believe me. I mean, if you look at what they've been doing for the last 3 to 4 years, that's been the strategy, and the subscriber growth sort of speaks for itself.
Netflix has a range of films in the works, including projects from Adam Sandler and Sofia Coppola, plus a sequel to Crouching Tiger, Hidden Dragon. This as it looks to compete with HBO and lure more subscribers with can't-miss content. Meanwhile, Hulu, which has until now been focused on TV shows, is also shifting gears to step up the competition. It's snapping up those Epix films to round out its catalog, starting October 1st. Owned by Disney, Fox, and CNBC's parent NBC Universal, Hulu's broadening its appeal as it looks to grow its subscriber base beyond the 10 million it has now.
These kind of rights don't come up very often. And I think it's not a surprise given the investments that Hulu's made recently. Look at the Seinfeld deal they did. They are spending more money than they have historically.
Hulu's stepping up its game as Amazon also ramps up its investment in its own original shows, plus other content rights. This after the company invested $1.3 billion in Prime Instant Video last year. And traditional TV channels, including HBO, are fighting back with their streaming video apps, as media companies, digital and traditional, look to capitalize on the new opportunity, as faster broadband speeds drive an explosion of digital streaming. For Nightly Business Report, I'm Julia Borston in Los Angeles.
As you know, starting a business is never easy. When we come back, though, we'll take you to a Texas town that averages more than 500 new entrepreneurs a month. That's coming up next. Looking to start a new business? Well, you may want to head deep in the heart of Texas, where one study named Austin as the top-ranked metro for startups. Kate Rogers tells us why.
Austin, Texas may be known for live music and barbecue, but these days it's gaining steam for something else. Its vibrant startup scene. At age 14, Isabella Rose Taylor is one of Austin's rising small business stars. This year, she was awarded Emerging Woman-Owned Business of the Year by Governor Greg Abbott. Taylor launched her company at age 10, graduated high school at 11, and went on to show at New York and Austin's fashion weeks, even landing her clothes in Nordstrom stores.
It all started with art for me. I've been painting since a very young age, and that really led me to fashion through way of sewing. I was doing a lot of mixed media, incorporating fabric into my art. So that led me to an interest in sewing. I took a sewing class and fell in love with the world of fashion and haven't stopped since.
Her Fashion Week debut was thanks in part to Austin-based tech powerhouse Dell and its Women's Entrepreneur Network. Startups are launching at record rates here in Austin. In fact, in 2015, there were an average of 550 new entrepreneurs per month in the metro, according to the Kauffman Foundation. Technology companies like Spiceworks, which has raised a total of $111 million in venture capital funding so far, are laying the groundwork for an alternative tech scene to rival both Silicon Valley and Silicon Alley. In fact, the social network for IT pros just snagged a big hire in new CFO Amir Movafagi, a former Twitter executive.
Austin has absolutely achieved critical mass on at least our scale in terms of the number of companies that are hiring people, I think producing good business leaders. We've always had good tech talent here. I think we're now developing new business tech leaders as well. And so I think there's critical mass not only for the companies that are here now, but also those that are come that hopefully, and maybe some of us are producing a sort of a Austin style of managing tech companies.
And for newer startups, there's Capital Factory, an incubator, accelerator, and fund all rolled into one. At any given time, there are up to 400 startups in residence working and hoping to become the next big thing.
There's a lot of overlap in what has historically been, the live music capital of the world has a lot of creatives. And so we have, I think by nature, we have a culture that is very innovative as a city. We have a university that has a lot of great talent. We've been blessed with some extraordinary successes that have created an ecosystem where there's other angel investors that are willing to invest in early stage. And I think Austin has sold itself over the years. Where else can you eat breakfast tacos?
For Nightly Business Report in Austin, Texas, I'm Kate Rogers.
And finally tonight, when is winning the lottery not winning the lottery? Well, according to the Chicago Tribune, a Chicago couple was thrilled when they won $250,000 from the Illinois lottery last month. But instead of a check, they got an IOU. Because since lawmakers haven't passed a budget, disbursements of winnings of more than $25,000 have been halted. So for now, the big winners are a bit out of luck. That's it for Nightly Business Report. I'm Sue Herrera. Have a great evening. We'll see you tomorrow.